Boeing has been in the gutter for the past few years now, and really since the 2020 sell-off there, which now puts them at a market cap of 126 billion, a undefined PE, and let's not forget to mention here their slashed dividend as well. So now it's time to take a value investing approach to their Q4 2022 earnings results, which were released earlier this week here, so that we can answer the questions most investors are wondering right now, and to see if we can get a better idea of where things stand here with Boeing and the future of this business. So make sure to stick around to the end of the video as we'll answer all those questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. In today's video, we'll start off by analyzing the fundamentals. We'll go through everything, the top line, bottom line, balance sheet, cash flows. We'll use all that information along with the key investing data here to end the video off with our intrinsic value calculator here, which will identify the margin of safety buying opportunities with Boeing. And finally, we will conclude the video off with our investment rating and where we think this business will go to in the future. And if you do enjoy this type of content, make sure to like the video, smash that subscribe as well, and don't forget to leave your thoughts in the comment section below. With all that being said, let's jump into the analysis. Okay, so we're starting with Boeing's Q4 2022 earnings results. Well, we already knew coming into this year that they have been going through quite a challenging period, but let's actually look at this from a fourth quarter perspective. And right off the bat, we can see here, especially if you compare this to last year's results, they produced $20 billion in revenues this quarter alone. If we compare that to last year, $14.8 billion, we've seen a nice step up there, at least in terms of their revenue recovery. We know the lockdowns and everything meant that Boeing took a massive hit to the fundamentals, and their current projections here are that they're in that revenue recovery and fundamental recovery stage right now. We can still see how their margins are looking right now, a negative 3.3%. Earnings or loss per share, I should say, is at $1.75. You know, that was still able to contribute to a $3.1 billion free cash flow figure that they produced for this quarter. If we do compare these again to last year, though, a nice improvement on those margins. You know, those were at negative 30% last year, so a sizable increase there. They've also recouped a bunch of those losses per share, and then they've also bumped up that free cash flow figure there. Now, if we look at this from a full year perspective to see how they actually did on a year-over-year basis, well, they only bumped those revenues up about $4 billion. And as you can tell, if we go back to that first slide there, that's pretty much just what they did in the fourth quarter alone. So fourth quarter was a strong quarter for them, yes. But besides that, if we look at this from a full year perspective, you can see here operating margins actually did decline here on a year-over-year basis. And from a full year perspective, that's not good. And same thing with their losses per share. Those actually extended for the full year of 2022, but still allowed them to go from, negative $4.4 billion, in free cash outflows up to $2.3 billion in free cash flow. So at least from a cash perspective, they started generating some decent cash there, and we'll talk more about that in just a second. First, let's go through their commercial airplanes, which is their main revenue segment here. $9.2 billion in revenues here. You can see that expansion on a year-over-year basis, but I want you to particularly look down here at this operating margin perspective here. Really bad numbers last year. So now they've recouped some of those losses to a negative 7% operating loss here, but still those margins really need to improve if any value investors or investors as a whole are going to get interested with this stock here. Now, that still did constitute about 152 airplane deliveries, and they are still fighting through a backlog of 330 billion, which is absolutely massive backlog to be dealing with. And based on the current economic situation, you can kind of understand why. Now, if we look at this chart here from Main Street Financial Data, the first link in the description, we can actually see the total commercial airplane deliveries and contrast that back over the last few years. We can see before the 2020 crash there, they did have deliveries up in the 800s figure. Then once 2020 came around in 2019, that really fell down to just less than 400 deliveries. And we've seen how they've had that delivery recovery here. And now they actually have improved to levels that are surpassing those 2019 levels. So that is very good for investors to see. And we're going to want to see if we can get back up into those 800 figures to where they were operating prior to the 2020 crash, because we'll talk more about it once we get to our calculator, but it's going to be very important for this business. Now, their next largest segment here is defense, space, and security, a big segment for them, and it actually produced about $6.2 billion in revenues. Now, not too much higher than last year, but if we look at this from an operating margin perspective, actually positive numbers there. Okay, they are also fighting through a $54 billion backlog, and I think investors are going to want to see these numbers increase further as well. Lastly, if we look at their global services here, 4.6 billion. Again, not too much of an increase year over year, but still an increase is what you'd want to see. Operating margins last year were actually positive for this segment. Same thing for this quarter, and they actually have improved again. $19 billion worth of backlog. So altogether about 400 or so billion dollars worth of backlog for Boeing. And to put that into context here, they're trading currently at a $125 billion market cap. So $400 billion of backlog is massive. Now, when we look at this from an operating income perspective here, sales came in for the year, like we mentioned, 66 billion. Cost to produce their products and services, wow, 53 billion, let's call it 54 billion dollars. So eats up a chunk of those revenues there. Altogether worth about 63 billion dollars worth of total costs and expenses. And so after we deduct for general admin, research and development, etc., yeah, not much money's left over. In fact, they have a loss from operations here for the year of $3.5 billion. That has, like we mentioned, accelerated from last year's numbers. Now, if we take another look at this Main Street chart and we analyze their margins, this is how healthy their margins were back before the 2020 crash, up in that mid to high teens level. Now it's absolutely declined and down below 0%. So of course you're going to want to see them improve on their margins, and the management team needs to focus on that cost reduction while simultaneously cleaning up that backlog. Now, if we look at this from a balance sheet perspective, okay, at this point, $17 billion in cash and marketable securities. And we look at their total debt figure here, they have $57 billion worth of debt. That constitutes a BBB rating at this point in terms of a liquidity perspective. And yes, you know how we feel about this. They have way too much debt on this balance sheet when we compare this to their cash figures here of just less than 20 billion. And another contributing factor to why this stock is at the level it currently is trading at. Now, let's look at this from a free cash flow perspective. We've already mentioned it earlier, but $2.2 billion for the full year of 2022 in free cash flow. A sizable improvement over last year's results where they had a free cash outflow. And again, you can see the disparity between this quarter and this quarter last year, a massive improvement on those fundamentals. And well, now that they have produced, about $2.2 billion in free cash flows, what have they done to reward the shareholders? Well, just repaying down a slight bit of debt here. Of course, last year, this was actually much more of a focus for them, even with the free cash outflow figures that they had. But now it looks like they're focused on building up that cash and repaying down a little bit of debt. Now, I also want to make mention here, we mentioned at the top of the video, but their dividend has been cut. Now in the future, assuming fundamentals continue to improve the way they have been over this last year, you can expect in the future they'll likely reinstate this dividend once that backlog is cleared out, once they realize more of those deliveries, etc., which is something investors can look forward to. And you can see again how they have been improving on those fundamentals, at least from a free cash flow perspective over the past few years. Now, the management does recognize that there is a challenging environment ahead for them. Their demand is still strong for their products and services at this point. They're trying to manage their supply chain commitments for 2023, and they think they're on the right path to restoring their operational and financial strength. The thing is, though, you'd want to see them actually produce actual results here. I mean, I know commercial airplanes did improve in terms of revenues, but their defense, space, and security on a year-over-year basis, that's actually down a little bit. Global services is up fractionally. Boeing Capital, I know it's not too relevant, but that's down as well. And by the time we deduct for our cost of expenses and everything like that, yeah, you can see how these results don't actually look too favorable. A massive decline here on a year-over-year basis, again, to their defense, space, and security segment. So there's a lot more work for this management team. They need to clean up the expenses. They need to clean up that backlog. But with all that being said, they do have those financial targets here to produce up to $10 billion in free cash flow by the years of 2025 to 2026. This is a huge objective for them. Right now, as you saw, they're at $2.2 billion worth in the year of 2022. So over the next 3 years, they're expecting to 5x their free cash flow figures. That's going to be a steep hill to climb. They also expect to produce about $100 billion in revenues and achieve a 10% operating margin. And like we mentioned, they're trying to get back to those 800 or so deliveries by that year as well. So it's going to be very important these next few years. And you have to kind of make an investment decision now on whether or not you believe they can achieve these numbers. In 2023, however, they expect they should be able to double free cash flow for Boeing, up from $2.2 billion up to their high end of potentially $5 billion in free cash flows. So that'll be extremely interesting to see. They're expecting more of the same in terms of deliveries, a little bit of improvement on that end. So again, this is an extremely important time for Boeing. And for us value investors, we really need to take into consideration this is an important year and especially an important next few quarters. If they can produce quarters going into the future like they did with this quarter specifically, and especially improve on this quarter at least, then yes, I can see us getting back to these old levels down here. Because if you look at this from a historical point of view, before the 2020 sell-off here, we had operating income of, north of $10 billion, okay, on an annual basis. Obviously, once 2020 came around, 2019, we saw the massive declines there while lockdowns occurred and everything like that. But this is really what's going to frame our investment thesis here. So if we can expect that the business can get back, maybe not even to 10 billion right away. Let's assume that they can get back to somewhere in the middle here and actually achieve profitability. If we assume that this business can achieve, let's just call it a modest $2.5 billion over the next few years in operating income. If we expect a 10% return, they do not currently pay a dividend. If they can grow at 7% for the first 5 years, that normalizes out at about 4% on an average scenario of a 25 PE. The stock would be only worth about $72 per share. Now, in the very best case scenario, if the business could actually grow at about 10% for the first 5 years, that kind of drops down to about 5% on a normalized basis. On a 30 PE, the stock would still only be worth about $104 per share. And in the very worst case scenario, a negative 1% growth rate for the first 5 years as they navigate this challenging period, that bumps up to only just a 2% growth rate on a 20 PE. $36 per share is where this stock would be trading at. Now, why am I showing these numbers even though it's only 2.5 billion? Well, it's because I just wanted to add some context here. If we can actually achieve $10 billion of operating income going into the future, like they plan to within the next 3 years on that 10% operating margin on $100 billion worth of revenues, again, if we keep these numbers all constant here, you can see how that really impacts the stock. So it really comes down to how much in operating income they can actually produce. And that is a huge part of the investment thesis right now. Can they get back to those levels that they were trading at previously, especially in terms of that fundamental recovery here? Because if they can, the stock price should be up to highs of almost $300 in a very normal case scenario with just average growth here. And in the best case scenario, the stock should at least double here. Let's not even talk about if they reinstate the dividend, what's going to happen to that stock price here, right? So if you look at these numbers, very, very attractive from a value investing point of view right now. But again, it always comes down to that decision you have to kind of make here on whether or not this business can actually achieve those metrics that they set out to and their targets. Because if they can, the stock is definitely going to be back up into $400 again, which may be what investors are already starting to wonder, since, the stock is already up about 74% since those lows back in 2022. So definitely at a crossroads right here with Boeing. Will this stock go higher? Will the stock go lower? I'm going to give this business an investment rating of about 5.5, which is just above average here for this stock. And the reason why is because we have seen that 74% increase so far from the lows down here with Boeing, right? And it would have been a very attractive investment down here at, low 100s. But now that it's up to $200 or so, it's a little bit different here from an investing point of view, and there's a little more risk involved here. But I think the main point here is whether or not you believe they can achieve their 2025, 2026 financial objectives, of $10 billion worth of free cash flow, $100 billion of revenue, 800 deliveries or so, and 10% operating margin. Because if they can, the stock will absolutely explode from these levels. And hey, this may even be the case where they're aiming for the stars and land on the moon. And, maybe they don't achieve $100 billion. Maybe it's only 80, but maybe they achieve 10% margin. So that's still about $8 billion in operating income there, and so if we enter that into a calculator, you can see how that changes our projections here. But let me know what your thoughts are in the comment section below. Do you think Boeing can achieve their growth metrics and their financial objectives, or do you think they're going to struggle for longer? If you've enjoyed the video to this point, like the video and subscribe because it greatly helps out the channel. And with all that, I'll catch you on the next one.